starting with just $100. I'm about to show you the exact step-by-step process that turns pocket change into serious wealth. Forget what you've heard about needing thousands to start investing. The biggest mistake beginners make is waiting for enough money while missing years of compound growth. Looking at real data from successful investors who started small, we'll break down the precise platform choices, stock selections, and growth strategies that maximize every dollar from day one. This isn't theory. These are the actual methods used by investors who built six-figure portfolios starting with lunch money. The wealth creation opportunity here is massive because most people overthink investing while missing the fundamental truth. Time in the market beats timing the market, and you can start building that time advantage today with whatever amount you have. Breaking down the mathematics of starting small reveals why $100 today is worth more than $1,000 10 years from now. A $100 investment growing at 10% annual returns becomes $259 after 10 years, while waiting 10 years to invest $1,000 only gives you $1,000 of starting value. You've lost $1,590 in growth potential. What this demonstrates about wealth creation is that starting amount matters less than starting time. Real investor portfolios show this pattern consistently. The person who invested $100 monthly starting at 22 has more wealth at 65 than someone who invested $500 monthly starting at 35, despite investing less total money. The behavioral finance insight here explains why most people fail. They focus on the size of their starting amount rather than the power of consistent investing over time. The market doesn't care whether you start with $100 or $10,000. But compound growth cares deeply about how many years you give it to work. Choosing the right investment platform determines whether your $100 grows efficiently or gets eaten alive by fees. Looking at the major platforms, Tiger Brokers and MooMoo offer zero-commission U.S. stock and options trading with Singapore-friendly features, while Robinhood provides U.S. market access, but with geographic limitations for international users. For $100 starting amounts, commission-free trading is non-negotiable because a $5 trade fee on a $100 investment is a 5% penalty before you even start. The platform comparison shows that Singapore-based platforms like Tiger Brokers and MooMoo provide full U.S. market access, plus local support and research tools, making them superior choices for Asian investors wanting to trade American stocks and options. What emerges from analyzing successful small investors is a clear pattern. They choose platforms based on long-term features rather than immediate convenience. The wealth creation difference comes from having access to research, education, and advanced order types as your knowledge and portfolio grow. Deciding between ETFs and individual stocks with limited capital involves understanding risk tolerance and learning objectives. With $100, buying individual stocks means putting everything into one company, while ETFs provide instant diversification across hundreds of companies. Looking at the risk-return profiles, an S&P 500 ETF like SPY or VOO gives you exposure to America's largest companies with expense ratios under 0.1%, meaning fees of just 10 cents annually on your $100 investment. Individual stocks offer higher potential returns, but require research and carry single-company risk. The wealth creation strategy that successful small investors use combines both approaches, starting with broad market ETFs for the foundation, then adding individual stock positions as knowledge and capital increase. This progression allows learning stock analysis skills while maintaining diversified growth from day one. Implementing dollar-cost averaging with small amounts maximizes the psychological and mathematical benefits of consistent investing. Instead of trying to time perfect entry points, investing $25 weekly or $100 monthly removes emotional decision-making while smoothing out market volatility. What the data reveals about dollar-cost averaging is counterintuitive. It performs better during volatile markets than during smooth uptrends because you buy more shares when prices are lower. Real portfolio examples show that investors who dollar-cost averaged through 2020 to 2022 market volatility achieved better returns than those who tried to time entries. The behavioral finance advantage of dollar-cost averaging eliminates the paralysis that keeps most beginners on the sidelines. Rather than waiting for the perfect time to invest, you develop the wealth-building habit of consistent investment regardless of market conditions. Identifying growth stocks suitable for small portfolios requires focusing on companies with expanding market opportunities and strong competitive advantages. Looking at historical winners, companies like Amazon, Apple, and Tesla shared common characteristics: growing industries, innovative products, and scalable business models. What distinguishes real growth opportunities from hype stocks involves analyzing revenue growth rates, market size, and competitive positioning. Companies growing revenue by 20% plus annually in markets worth hundreds of billions offer better wealth creation potential than mature companies in declining industries. The practical approach successful investors use combines quantitative screening with qualitative analysis. Screen for companies with 15% plus revenue growth, then research whether their products solve real problems for expanding customer bases. This method helps small investors focus on companies with genuine wealth multiplication potential. Building dividend-paying stocks into small portfolios creates immediate income while providing inflation protection and compound growth opportunities. Looking at dividend aristocrats, companies that have increased dividends for 25-plus consecutive years, reveals the power of consistent income plus capital appreciation. What emerges from analyzing dividend strategies is that reinvesting dividends dramatically amplifies wealth creation. A $100 investment in Coca-Cola with dividends reinvested would be worth significantly more than the same investment with dividends taken as cash, due to compound growth from additional share purchases. The wealth creation advantage of dividend stocks for beginners involves both psychological and mathematical benefits. Regular dividend payments provide tangible evidence of investment returns, while reinvestment purchases additional shares that generate more dividends in a positive feedback loop. Maximizing tax-advantaged accounts like Roth IRAs transforms small investments into tax-free wealth creation machines. A $100 investment in a Roth IRA grows completely tax-free, meaning decades of compound growth and dividends never face taxation upon withdrawal. What this reveals about wealth multiplication is that tax optimization can be worth more than investment selection. The difference between taxable and tax-advantaged growth over 30 years can represent hundreds of thousands in additional wealth, even starting with small amounts. The strategic approach involves prioritizing Roth IRA contributions before taxable investing because the tax-free growth benefit is permanent and irreversible. Once you use your annual contribution limit, you can never go back and capture those years of tax-free compound growth. Managing risk with limited capital requires balancing diversification needs with practical constraints. With $100, you can't diversify across 20 individual stocks, but you can manage risk through position sizing, stop-loss orders, and asset allocation principles. Looking at how successful small investors protect capital reveals a focus on downside protection rather than upside maximization. Using stop-loss orders at 15 to 20% below purchase prices limits individual position losses while allowing unlimited upside potential. The behavioral finance insight here addresses the biggest destroyer of small portfolios: emotional decision-making during volatility. Having predetermined risk management rules removes emotion from selling decisions and protects capital for future opportunities. Understanding sector rotation patterns creates wealth multiplication opportunities for small investors who can move quickly between trending sectors. Looking at market cycles, technology outperforms during economic expansion while utilities and consumer staples outperform during uncertainty. What emerges from analyzing sector performance is that small investors have advantages over large institutions. They can move capital quickly without market impact and concentrate in specific opportunities without diversification requirements. The practical wealth creation strategy involves identifying which economic cycle phase we're in, then overweighting sectors that historically outperform during those periods. This approach allows small portfolios to capture outsized returns from sector momentum while maintaining broad market exposure. Implementing basic option strategies can amplify returns and generate income from small stock positions. Selling covered calls on stock holdings generates monthly income while maintaining upside participation, effectively creating your own dividend payments. Looking at the risk-return mathematics, selling calls on a $100 stock position might generate $5 to $15 monthly income depending on volatility and strike price selection. This represents 5 to 15% monthly yield, far exceeding traditional dividend yields. The wealth creation opportunity comes from reinvesting options income into additional stock purchases, creating a compound growth cycle where options income buys more shares that generate more options income. This strategy works particularly well with volatile growth stocks that command high option premiums. Monitoring small portfolio performance requires focusing on the metrics that matter for wealth creation rather than day-to-day fluctuations. Track total return, including dividends. Compare performance to benchmark indices, and measure progress towards specific financial goals. What successful small investors understand is that frequent monitoring can hurt returns through emotional overtrading. Weekly or monthly portfolio reviews provide sufficient information for decision-making without triggering impulsive reactions to short-term volatility. The optimization approach involves regular rebalancing between asset classes and reinvesting all dividends and distributions. These mechanical actions remove emotion from portfolio management while maintaining strategic allocation targets that maximize long-term wealth creation. Developing a systematic approach for scaling investment strategies as your portfolio grows from hundreds to thousands to tens of thousands creates a clear wealth-building roadmap. Starting with broad ETFs, adding individual stocks, then incorporating sector rotation and option strategies provides natural progression. Looking at how successful investors scaled their approaches reveals common patterns. They maintained core positions while experimenting with small percentages in new strategies, gradually increasing complexity as knowledge and capital grew. The wealth creation framework involves setting specific milestones. At $1,000, add individual stock positions. At $5,000, begin sector allocation. At $10,000, implement option strategies. This systematic approach ensures you're always using strategies appropriate for your capital level and experience. Avoiding the classic mistakes that destroy small portfolios protects your wealth creation potential while you're learning. The biggest destroyer of beginner wealth is emotional trading, buying high during excitement and selling low during fear. What the data reveals about failed small investors shows consistent patterns: overtrading, chasing performance, lack of diversification, and ignoring fees. Each of these mistakes can be eliminated through systematic approaches and predetermined rules. The behavioral finance solution involves automation wherever possible. Automatic investing removes timing decisions. Automatic reinvestment removes spending temptation, and predetermined risk management rules remove emotional selling pressure. Your pathway from $100 to substantial wealth is clear and achievable through consistent application of proven investment principles. Open a commission-free brokerage account. Start with broad market ETFs, implement dollar-cost averaging, and reinvest all distributions automatically. The wealth multiplication opportunity ahead of you is enormous because you're starting with the most valuable asset, time. Every month you delay costs compound growth opportunities, but every dollar you invest today begins working immediately toward your financial independence. Subscribe to Premium Logic Lab for more practical wealth-building strategies that turn small amounts into serious money. Which investing approach resonates most with your situation? ETF foundation building or individual stock research? Comment below with your $100 investing strategy, and remember, the best time to start was yesterday. The second best time is today.